Picking the right dividend stock is the ultimate challenge of investing if growth and income is your goal. The first question any new dividend investor will ask is, where do I start? The second question is usually, how much do I need to provide dividend income of $100 a day or something like that? That's what this video is for. Hey folks, I'm Daniel, let's dig into it. Any discussion about picking dividend stocks must start with two different lists, the dividend aristocrats and dividend kings. If picking individual stocks isn't your cup of tea, stick around because I'm going to include discussions of some ETFs as well. Regardless of whether it's for an ETF or a portfolio of individual stocks, the fundamentals are the focus here. So what is a dividend aristocrat? Simply put, it's a list of companies in the S&P 500 index that have increased their dividend annually for the past 25 years. So why is this significant? Well, to start, it means that they're one of 500 of the largest publicly traded companies in the US. Already, that's a fairly elite group to be in, with a total of around 6,000 companies out there to pick from. But beyond that, 25 years of increasing dividends is no small feat. It means that throughout the market turmoil of the early 2000s, with the dot-com bubble, the Great Recession and all that occurred in the market from 2007 through 2009, and then the 2022 bear market when the S&P dropped about 20%, they still managed to find a way to deliver. This is a high bar for a company to meet, and only 67 companies qualify for the dividend aristocrat designation. In addition to being a part of the S&P 500 and having 25 straight years of dividend increases, they must be worth at least $3 billion at the time of each quarterly S&P 500 rebalancing, and they should have an average trading volume of at least 5 million for the trailing 3-month period. This list includes companies like Walgreens, ExxonMobil, Johnson & Johnson, Caterpillar, McDonald's, Walmart, and more. The highest dividend yield on the list is for 5.91% and the very lowest is 0.22%. It's very heavy in the consumer staples sector at nearly 22%, followed by industrials at 19%, financials at 13%, materials at 12%, and healthcare at 11.5%. You might have noticed that it does not have a heavy concentration in either the tech sector or the energy sector, and that is because both industries typically experience significant volatility, which makes it difficult to be consistent. Consistency is key for long-term dividend planning, and there's nothing more consistent than hitting the like button to guarantee insane returns on your portfolio. It's basically printing money. Earlier, I promised an ETF. I love an index ETF because it's elegant in its simplicity. In order to benchmark any fund, you have to have an index because you cannot invest in an index itself. When I look at any ETF, I primarily consider 4 different metrics. I want a very low expense ratio, a large number of assets under management, low volatility, and a long track record. In this case, S&P has us covered with their index of SPD AUDP, which averaged a dividend yield of 2.26%. It currently sits at a 1-year return of a negative 5.5%, but that's not surprising considering the market in 2022. They currently only list 2 ETF directly linked to their index, and they are KNG and NOBL. NOBL has a reasonable expense ratio of 35 basis points and 10 billion in assets under management. KNG is fairly small at about $500 million in assets under management, and I really don't like this 75 basis points expense ratio. There are plenty of other dividend ETFs from companies like BlackRock's iShares, but you can buy a dividend ETF from pretty much any large vendor like Schwab, Fidelity, or Vanguard. Okay, so if you aren't ready to commit to a dividend aristocrat, there's plenty more out there. Earlier I mentioned a dividend king. This is a separate list, but there's also some overlap with the aristocrats, with 24 of the 46 kings also being aristocrats. A dividend king is simply a company that has increased its dividend for at least 50 consecutive years. That's it. My work here is done. But seriously, it's not that complicated. There are no restrictions where you have to be a part of an index or be worth at least $3 billion with a certain trading volume. None of that. Here you can see that the top of the list is Altria with a yield of 8.46%, and all the way down we go to Tootsie Roll at 0.78%. What this means is that it's much harder to index because there are no capitalization requirements like the S&P 500. You can see here that it's heavily concentrated with consumer staples and industrials, with help from healthcare, utilities, and consumer discretionary. You won't find any energy or tech stocks here. Similar to aristocrats, these industries are subject to rapid change with high levels of volatility, which is not ideal for anything that requires 50 years of consistency. So back to the original question, $100 a day in income from a dividend portfolio. It's going to vary depending on your approach. If you stay conservative and just invest in the index, you'll likely see capital appreciation with a very conservative dividend. NOBL would be a fairly reasonable investment, but its yield was fairly low at 2.59% as far as dividends go. This means that if we don't want to sell off any shares and we just live off of dividends, we'll need $1.4 million invested in NOBL to generate $36,500 a year, which is $100 a day. If we went a bit more aggressive, invested in SCHD, which is Schwab's ETF that is indexed to the Dow Jones US Dividend 100, we would see a higher yield of 3.61% currently, which means we'd need to have a bit over $1 million invested to generate an average of about $100 a day in dividends. The thing to keep in mind here is that we don't want to get too focused on dividend yield. I don't want to encourage someone to get caught in the yield trap and invest in a company that is circling the drain. We want to buy good companies or groups of companies if we're looking at an index at great prices. Anytime I look to invest in a company or an ETF, I recommend going back as far as possible. A 1 or 2 year history of a company is just a small window to examine, and it's not enough to capture the big picture. So if we go back to the Dow Jones Dividend 100 index that SCHD is benchmarking, we can see that although it's currently down about 7.5%, the 10-year return of the index is at about 8.5%, and it doesn't include dividends that SCHD is paying out. The life of the fund pops up even more to 13.27%. It's not on fire, but it's solid. Even if the market draws back another 20%, these companies will continue working to deliver value to us, the shareholders. We can take this approach with anything. There are comparable funds out there such as DVY, VYM, or HDV. No matter what, think long-term about your total portfolio goals, including both dividend yield and overall appreciation. If you like this video and want to watch some more of my other investing videos, click here. Thanks, and until next time.